Banks in Nigeria have reported third-quarter results that have lifted the broader market, albeit most modestly. Some analysts were expecting a stronger rally, but the NSE All Share Index is flat so far this quarter after falling 15% in the third quarter, while Famurewa reports on the key takeaways from the bank's earnings season.
Nigerian banks are looking healthier than they've been in 3 years, with capital adequacy ratios on average around 20%. Third-quarter results further confirmed the recovery and the attractiveness of the sector to portfolio investors.
On average, we've seen balance sheet growth of between 10 to 15% across the banking sector. In some cases, even more than that, especially for the likes of Fidelity. The second thing is also lending. If you look at this year, we've had about 15% growth in credit to the private sector, but much of that has come in Q3. So out of the 15% growth, we've had about 12% coming in the third quarter of this year, which again is just coming out of AMCON. Having supported the banks, having helped them clean up their loan books and balance sheets. But loan expenses, interestingly, partly because of what AMCON is doing, forced sales and the haircuts they have to take, then we're seeing that also feed out in the P&L. So balance sheet gets better, but they need to take some write-off through the P&L.
During the quarter, the Central Bank's Monetary Policy Committee raised the benchmark monetary policy rate twice to 9.25%. More recently, in a special meeting held in October to address the volatility of the Naira, the MPC raised the key rate to 12%. While the bank's Q3 results reflect interest income gains from the higher interest rate environment, analysts are moderately concerned about the losses that banks may have to absorb when bond portfolios are marked to market.
And with that sharp movement that we saw in interest rates, up to 500 basis points in some instances, we think that's a very significant cause of concern for the banking sector. What's more important is even the fact that most of the bonds that have been issued by AMCON, a lot of them are also held by banks, even though some have been repoed. And those being discount instruments are likely to be even more affected by the sharp spike in interest rates.
Now that we've seen adverse movement in the yield curve, what you see that the trading book definitely will bring in some losses to the P&L of these banks, particularly in Q4 because of that yield environment that we've seen. And if I should say from an industry perspective, trading book largely is just maybe an average of around 10% to the overall bond portfolio of most banks. And that's why I said it's actually been overflowed. And I think one key issue that you also have to take note of is the fact that the yield environment is actually moderating anyway. The longer end of the curve is almost closing that gap relative to September 30. Say, for instance, the FGN 2030, which of course is the 20-year bond that we have in the market now. I think currently now it's trading at around 13.97% yield to maturity. And of course, as of September 30, which of course is the relevant period when you're looking at Q4 impact on their books, I think as a Q4 it was actually around 12.57 as of September 30. So you said that that gap is closing gradually. This was an instrument that went as far as 16% when the extraordinary meeting of the MPC came up with that aggressive tightening.
The quarter ended with 3 acquisitions: Access Bank taking over Intercontinental, EcoBank Transnational buying out Oceanic, and Sterling Bank acquiring Equatorial Trust Bank. The consolidation highlights the fiercely competitive environment where 21 lenders battle for 10 trillion naira in deposits.
You know, scale becomes important as an outcome of this acquisition. A lot of them are really aiming to just get into the tier 1 category. So you see the funding costs trend lower, you see NIM go upwards. I would think it's something that could really change industry dynamics. More importantly, perhaps not for the acquirers, perhaps for the mid-tier to smaller banks, who would then be left behind.
Before the crisis in 2009, most banks were actually struggling based on scale. Everybody wants to become big. And that's why you find the likes of Intercontinental, Oceanic, they're all struggling to become the tier 1 bank. Don't forget that GT Bank before now, say for instance, before the recapitalization, after the recapitalization in 2005, GT Bank wasn't a tier 1 bank. But GT Bank's scale currently now, it's a tier 1 bank, and it's not just a tier 1 bank to be reckoned with in Nigeria, even outside the country. It's growing its balance sheet even outside the country. That GT Bank built its own scale on efficiency. So building your scale on efficiency is what is key for us to actually look at. The fact that you're big can actually bring these economies of scale.
While Nigerian banks performed well in the third quarter and provided some support to the bourse, the market will be watching full-year numbers to be released in April next year to confirm whether the recovery can be sustained.